Hey everyone, welcome back to Corporate Decoder, the place where we break down the complex world of business and finance. And today we have nVent Electric PLC's latest quarterly report. Let's just say they've been busy making some big moves, almost like a Swiss watch with a few extra gears added. This is a look at their financial health for the quarter ending the 30th of September 2025. And let me tell you, there is a lot going on under the hood. First off, let's peek at the balance sheet. The company's total assets stand at a solid $6.7 billion as of the 30th of September, which is just a little bit higher than back in December of 2024. But what is really interesting is how those assets are shifting. Notice how much of their assets is tied up in goodwill and intangibles. We're talking about almost $4.6 billion here. Goodwill is basically the premium they paid over the fair value of a company they acquired, and it can be a sign of smart acquisitions or overpaying. Let's see if that pays off. Now let's talk about sales. For the 3 months ending the 30th of September 2025, nVent pulled in over $1 billion in net sales. That is a big jump, a 34.8% increase compared to the same period last year. A big part of that growth, 16% in fact, is from what they call organic growth. This means they made more sales with the products they already had without buying new companies. That is usually a healthy sign. And then you have another 17.8% jump thanks to acquisitions. They bought the Electrical Products Group and Tractay, which are clearly boosting their top line. It looks like their strategy of acquiring companies is really paying off in terms of revenue. But what about making money on those sales? Gross profit, that is the money left after making the products, was 37.4% of sales. That is a slight dip from last year's 39.8%. This suggests that their costs to make things went up a bit more than their prices, or maybe they had to spend more to get those products out the door. Their selling, general, and administrative costs, basically their operating and overhead expenses, were 19.7% of sales. That is a small improvement from last year, showing they're getting a little more efficient at managing those costs as sales grow. All of this leads to operating income, which is like their profit from running the business before interest and taxes. It came in at 15.8% of sales. This is down a bit from last year's 17%. While sales are up, their costs have outpaced that growth a little bit, squeezing their operating margins slightly. When all is said and done, their net income for the quarter was about $121 million. That is up from about $105 million last year. So a decent increase in the bottom line, even if margins were a little tighter. And looking at continuing operations, which excludes the results from businesses they've sold off, they made $119 million. That is a really strong jump of over 50% from last year. So the core business is performing well. Now, the discontinued operations story is quite interesting. They had income of just $2.2 million from these. Last year, it was over $26 million. Remember, they sold their thermal management business in January 2025. That sale was a huge driver of income last year, and this year's number reflects the final bits and pieces. Let's zoom out and look at the 9 months ending the 30th of September 2025. Their net sales hit a massive $2.8 billion. That is a 25.4% increase over the same period in 2024. Again, acquisitions like Tractay and the Electrical Products Group are playing a big role, adding over 16% to that growth. Gross profit as a percentage of sales for the 9 months was 38.2%, down from 40.4% last year. So that same pressure from rising costs is affecting them over the longer term too, but they are getting some benefit from higher sales volume spread across their fixed costs. Operating income for the 9 months was 16% of sales, a little lower than 18.2% last year. It seems they're investing more in growth and dealing with some cost inflation, which is typical in today's economy. And for the first 9 months of the year, net income is a staggering $591 million. That is a huge 84% increase from last year. So while margins are a bit tighter, the sheer volume of sales and the profit from selling off that thermal management business really pumped up their overall profit. The big story for the 9-month income is that $278.7 million from discontinued operations, mostly driven by the gain from selling that thermal management business. That sale was a massive win for them, bringing in over $1.5 billion in net cash. So they are really cleaning house and focusing on their core businesses. Let's break down their business segments. Systems protection is their biggest area, bringing in $1.8 billion in sales for the 9 months. That is up over 36% from last year, fueled by those acquisitions and strong organic growth, especially in infrastructure. However, segment income for systems protection as a percentage of sales dipped slightly to 20.9%. They're facing inflation and investing in growth, which is impacting margins. Their electrical connections segment brought in $970 million in sales, an 8.3% increase. This is also a good result driven by organic growth and some contribution from acquisitions. Interestingly, segment income for electrical connections as a percentage of sales is higher at 29%, though it is also down from last year. This segment seems to be managing its costs a bit better relative to sales. Now, for a quick look at cash flow, they generated a healthy $426 million from operations in the first 9 months of 2025. That is a solid increase from last year, showing they are converting sales into cash. However, their investing activities show a significant outflow, mainly due to the Electrical Products Group acquisition, which cost almost $1 billion, plus nearly $57 million in capital expenditures. Financing activities show a large outflow of over $900 million. This is primarily due to paying down debt, share repurchases, and dividend payments. They paid back almost $870 million in long-term debt and bought back shares worth over $250 million. It seems they are actively managing their debt and returning value to shareholders. Looking at their debt situation, they have about $1.6 billion in debt. While they've been paying it down, they also took on new debt for acquisitions, like the 2025 term loan facility. It is a balancing act, and good news for shareholders, they still have about $147 million available for share repurchases under their current program, signaling continued confidence in returning value. So, what is my take on nVent Electric PLC? They're executing a strong growth strategy through strategic acquisitions and organic expansion, especially in areas like infrastructure. The sale of the thermal management business was a huge financial success that is cleaning up their balance sheet and funding further investments. However, they are facing some headwinds with inflation and rising costs, which are slightly impacting their profit margins. They are managing their debt effectively and returning cash to shareholders. The company's direction seems solid, focusing on key trends like electrification and sustainability. The main risks are the continued impact of inflation, global economic uncertainties, and the integration of their recent acquisitions. But overall, nVent appears to be a well-managed company with a clear strategy for growth and shareholder value creation. Alright, that is our breakdown of nVent's latest financial report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord community for more engaging discussions linked in the description below. Thanks for watching. See you next time.